Welcome, everyone, to the May monthly update from Principal Wealth Partners. I'm Julina Ogilvie, partner and wealth advisor, joined once again by Bob Paolucci, our founder and CEO. Hello, Bob.
Hello, Julina.
So the title this month is "A Cut is a Cut," which I think is interesting because the Fed just met for their May meeting. They announced no cut, and yet you and I are going to talk about how we think they actually did have a cut. And we have, of course, some other things to talk about as well, but that is hence the title.
Yeah, they used one of their other tools that is less known, less talked about, but very effective. Hence the title, "A Cut is a Cut." They cut something, and we're going to show it to you.
Yeah, absolutely. If we can go through the agenda, which really is broken into two today, we're going to talk about what we think matters most to the markets and the economy, but we also want to address some other things that we're watching.
Absolutely. Yeah. So we'll get into the Fed's quiet cut. You really had to pay attention or really know what they were talking about. I don't want to say they pulled a fast one on us all, but they did do something. It is stimulative. And the stock market and bond market woke up a little bit. More to come on that. Also, with their language, rate cuts are coming soon. We'll get into that a little bit. These are the things that matter most, right? There's monetary policy, which is the Fed's cutting cycle. We have cash on the sidelines. We talk about this because it provides fuel for a bull market. There's so much cash on the sidelines that came from the capital markets. What we see like clockwork over long periods of time is it re-enters the capital markets shortly after peak cash, right? We'll get into that. The fundamentals of the capital markets, so whether that be the credit markets, the bond market, or the stock market, things like earnings, dividends, buybacks, good shareholder activity, this is all screaming great bull market, potentially be here for a long time. We'll get into that. So that stuff that we just talked about, what matters most, that should always be focused on the most because that's what really matters. It gets very boring, but that is the foundation to any business cycle, any bull market, and really any bear market. It's what is in that top part of this screen that drives it.
Which is
There,
why we talk about it so much.
which is why we talk about it so much, and we want everyone to focus on that.
Yeah.
Then there's other smaller stuff, which matters, but you would have to glue everything together and get it rowing in the same direction to actually matter, whether it be positive or negative. But we talk about it because you'll probably hear about it. And those things are small business sentiment, consumer sentiment. It appears that there's just too much money being indexed nowadays, and what that means for investors, and we'll show that to you. We'll talk about housing, showing that there's nowhere to live, but that might change soon. We have a slide in there called "Change Happens Fast." We'll just show you some of the economic data that went from good to less good, which is why we certainly think the Fed is going to be cutting rates very soon. And then know your time frame. So as an investor, your time frame, amongst other things, will dictate how money is invested for you on your behalf and or how you should invest your money. And we will we'll end our presentation with that. We'll keep that a secret until we get there. How's that sound?
That sounds good. Absolutely. Thank you. So let's first address this, what we term the Fed's quiet cut. And I think to do this, you actually have to look at the language from the meeting.
Yeah. Yeah. So sorry to bore you. So what we did here is we put up the screen. For those watching, you've probably seen this very boring screenshot before, but this is a comparison of the Fed's language from the last meeting to the language at the most recent meeting, of the before and after, and the red lines are the new stuff, right? So there were some red lines up top. They just subtly changed the language, really didn't put anything too new in there. But it's that paragraph that we circled. And what they did there is they announced their quantitative tightening program, which is the Federal Reserve taking the balance sheet, the ownership of their treasuries, right? Think about you owning bonds. You own this big bond ladder, and you just let the proceeds mature, right? And your bonds mature into a money market account, right? Well, the government is the biggest owner of its own bonds, and when they don't reinvest the proceeds, it has a tightening effect on the economy. through the lens of liquidity, right? There isn't as much money put back into the system. What ends up happening? Yields rise. So the Fed being the big buyer, if they're not buying bonds, then yields rise, right? So the big auction buyer of treasury bonds being ourselves, the US government, when we don't go to the auction to buy up all this stuff, yields come up. On the short term, really doesn't matter because that's what overnight rates are for, the Fed's other policy tool. But this one is more effective in the 2 to 10 year interest rate environment because it's those bonds that they were buying for the past decade and a half, hand over fist, that allowed them to control the rest of the yield curve and bring rates down.
Yeah, this
What
was coming after the financial crisis, the quantitative easing.
That's when it started,
Yeah.
exactly. They actually haven't stopped until
No.
a couple of years ago.
Yep.
And then they just stopped. So they were just letting all those bonds that they bought mature and not putting the money back into the system, right? Now they announced, hey, we're changing the pace of it. So in English, they are going to reinvest money back into various parts of the bond market, government bond market, which has a rate cutting effect. In essence, these slick little fellows are going to start to control the yield curve again. Why does that matter and why are they doing it? They're doing it because many lending rates out there, mortgages, auto loans, pension GAT rates, pension calculation rates, there are many big lending and liability rates tied to longer term bonds.
Right.
And that's where there is an issue. It's very hard to get pre-approved, your kids to get pre-approved for $1 million mortgage nowadays at 7.75%. It was easy at 2.75. At 7.75, it's very hard
Different
because
story.
right. So the Fed is aware of this. So what they've done is they've targeted the rest of the yield curve, not overnight rates, with this move. And long story short, it is the equivalent of a cut. And we're going to show you some fuzzy math on the next slide.
Yeah, and I would just quickly add, this is not a surprise to us. We actually alluded in past conversations that they may do this before actually cutting rates.
Yeah, absolutely. Let's take full credit for that. We mentioned this we mentioned this quirky little thing in February as this tool that everyone has forgotten about, that we think they're going to use to start the easing process. We talked about it in February. Then the Fed talked about it in March. How about that?
Yeah.
Pretty cool.
Absolutely.
And now in the May statement, it's in writing that it is effective. They're making a change to it, effective the month of June, because they need a little while to do it.
Yeah.
So in English, what does this mean? Well, they were letting $60 billion of treasury approximately mature out of their portfolio of bonds, let's call it. Now they're only going to let 25 billion a month mature. So what's the delta? The difference is about 35 billion a month will be put back into the yield curve. So the Fed is becoming a net buyer again, or a buyer again. And that is going to have a rate cutting effect. Our fuzzy math shows that based on our math, the percent that they reduce this plan by times the equivalency of it in terms of feels like a hike or a cut, their QT program makes it feel like rates are about 0.75% higher than what they really are. They're cutting the program by about 60%, which gives you the equivalent of a 44 basis point cut or almost a half a point cut. I know that's confusing, but we're nerds when it comes to this stuff and we love this stuff. So I can tell you it's not only us who sees this, it's the bond market, more importantly, who sees this. The 10-year treasury has actually gone down for no other reason than the announcement of this by about a 0.5% in a week. And that is a huge move. So we're not making this up. It's real. And hey, you notice the stock market stabilized, right? Coming out of a shaky month of April, the Fed talked, delivered this weird message that not many people really understood, which led to the press conference having poor questions asked. Here it is. The bond market is starting to price it in. The stock market is starting to price it in. This is good news. This is stimulative.
Yeah.
This is a very good move.
And I think this is important for investors to understand why the bond market and the stock market can move, even though the Fed technically didn't cut rates.
Yep.
There's another effect in the market. The bond market sees it and the stock market sees it. And that's,
They used a different tool, a
yeah.
lesser known tool that's way more complicated. Uh,
Okay. Yeah.
so, but they did something. Finally, they took action, and it was stimulative, and this is a very good thing. So,
And there's another reason we believe that they did this, which is
yeah,
coming from Janet Yellen.
yeah. Here's my deep dark conspiracy theory side. So Janet Yellen is the head of the Treasury. Jerome Powell is the head of the Fed. Janet Yellen was the prior head of the Federal Reserve, so she knows this game well. She thinks she's a dove. She thinks the Fed is too restrictive, and if she were at the Fed, trust me, she'd be cutting rates. She would have cut already. She's very vocal about it, and she I believe she influenced the Fed's decision by pre-announcing the fact that yes, the government, after receiving all of its tax revenue in April and estimates for future quarters, and we'll get another injection of that capital in June for the next tax estimate period. She wants to raise even more money, partly because she doesn't want to deal with a debt ceiling conversation this year at
Of
the end of
course.
she wants to push it into the following year and leave it for potentially the same administration, potentially a new administration. So you handle it. But what does that mean? Well, if she's looking to borrow more money, that means they have to issue more treasuries, which means there needs to be buyers for those treasuries, right? This is going to lead to an issuance of more debt. And usually that means slightly higher rates when you issue those bonds that were above the initial expected sum of money that was going to be raised. Does that make sense?
Yeah, absolutely.
So I think she did this, and her timing of announcing it was interesting. It was almost like a warning shot to the Fed to say, hey, what are you going to do now? Are you going to let those longer term rates go higher? So I think the Fed listened and decided to do something about it. I can't prove this, but the timing of her announcement and the fact that she wants to raise more money, seeing that they have raised more money than ever in history
Yeah.
recently, is bizarre. And it was just prior to the Fed meeting. Janet Yellen just checkmated Jerome Powell.
So I was just going to say whether the listeners believe you or not, right? We do have a couple more slides on why we think this cut is coming soon, because this is now the question. And the one we're showing here is just plain and simple. They have waited longer than usual. And going back to the 60s on this slide, you can see how long they've waited by month to begin cutting rates. And we're now in the fourth longest time frame.
Yeah, we're in extra innings. The Fed usually cuts by now.
Yep.
They're at a restrictive level for a long time now. They're going to be cutting soon. It makes perfect sense. They're getting pressure from Janet Yellen at the Treasury. They're getting pressure from the White House now. And, the bottom tier consumer is really feeling the pinch. They have to do something pretty quickly. You have inflation falling in line. If you measure it live, it's already there at their target. You have a slowdown in housing. You have no supply, mostly because rates are too high. So no one's going to sell and buy something else and lock into a terrible interest rate, seeing that they're coming out of a 2 or 3% rate. There were some unintended consequences of their actions. And something that no one else is talking about, higher interest rates are inflationary, right? So do the math on, 2% rates versus 6% rates. I mean, that's massive inflation when you factor in interest expense. And that can go away pretty quickly. So the Fed needs to get with the program. They will be very soon. They're already in extra innings. This chart proves it. We're talking now about something different. This is your traditional overnight rates. This
Correct.
is the Fed funds rate, the discount rate, the thing that the Fed directly controls.
Which is what everyone has been anticipating. So you think that June is still on the table?
I think June's still on the table. If it's not, it's because of the change to their other tool. July, September. September, for me personally, I think it's a definite. August, they have the Jackson Hole meeting. It's not really a meeting. They don't do anything during that meeting other than jawbone.
Yeah.
Um,
Okay.
we'll see. We'll see. But there's going to be some inflation reports that show a decline, potentially starting with the next one very soon. So
Yeah, and you mentioned the realflation, which we have talked about as well, but we have an update here for our listeners.
yeah, you measure it live, it's 2%. It's at their target.
Yeah,
Um,
absolutely.
it would be foolish for them to not look at the live data and rely on the lagging data. I, I, they talk about, the lags in the data that they're getting. Here it is live for you to guys to see. You can log into Trueflation every day and measure it. Just hit the button and you'll see what it is. All they do is they take all the data, measure live, categorize it, and get the average score. And here we are at 2.2.
Right at 2%. Yep. Thank you. And I think some reason for optimism in the markets, and we've talked about this before, but the fuel in the market, one of these is the cash on the sidelines.
Yeah, you could have a lot of good fundamentals. You could have good monetary policy, but if there's no cash on the sidelines,
Mhm.
right? It's like, hey, you finally went shopping for the house that you always wanted. It has the right countertops, the right cabinet colors, the right size property, not on the water, but pretty close. There's a white picket fence. You finally found it. Great. Do you have any money to buy it?
Yeah.
Right. So you found the perfect place, but there's no money to buy it. You could have all the proper market fundamentals, but you don't have money behind it that could be put into the capital markets, then
Sure.
it doesn't matter. Right. The reason why we show this is this really matters. This money came from the capital markets. It's sitting on the sidelines. It's going to re-enter the capital markets soon.
Yeah.
Um, the sheer size of this cash cushion, it's just massive. This has the potential to fuel a bull market, this bull market, for a long time. The longest bull market we've had, post 1950, is right there in the middle of the screen. The prior high level, just above 2010, right? So 2008 and 9, there was so much cash on the sidelines.
Yeah.
As the cash level decreased, the market went up, right? So as money was coming out of cash, it was re-entering the capital markets. It created a 10-year bull market.
Yes. There is historically a strong correlation to this cash on the sidelines.
Yeah,
Yeah.
it's almost a perfect correlation.
Yeah.
So I have a high level of conviction because, well, look at the amount of cash that's on the sidelines.
Yes.
This is what you need to fuel a bull market, and boy, oh boy, do we have it. To take a slightly more granular view, the next slide is
Yep.
corporate cash on the sidelines. Corporate cash is at an all-time high. This chart is just measuring Berkshire Hathaway's cash. We bring it up because the Berkshire Hathaway shareholder meeting was this weekend. Warren Buffett was talking about, their plans for cash. They plan to spend it and invest it. They even hit a new all-time high in cash.
Yep.
Keep in mind, the cash yields are okay, but they're trying to make 2 to 3 times as much as cash with their investments. They are a little behind the curve here. They talked about the need to put it to work, and they're going to start doing that. Keep in mind, they are putting cash to work, but they're very profitable, so they keep building this cash. But this chart looks like so many other companies, whether it be a lot of the top S&P components, Google, Microsoft, Apple. This one happens to be Berkshire, again, because of the timing of the meeting. So
Yep.
cash on the sidelines by corporations is at an all-time high, which is a great cushion for them to have.
Exactly. And Bob, you have mentioned the fundamentals. So let's quickly address the positive fundamentals that we see.
Yeah, so now beyond those foundational elements, now we're in some of the other categories, right? So earnings are strong, and so are expectations for future earnings. So what you see on this chart is the blue line are actual earnings, which generally speaking rise over time. The hash marks on the right-hand side, the green, the purple, and the red, are forward earnings expectations. Those are analyst forward earnings expectations. And usually what happens is the analysts are way too conservative, and the actual earnings come in higher.
Higher.
Over time, that has just about always been the case.
Yeah.
So that is a very good thing for stock prices. Let's just say that,
Yeah,
and a very
these conservative numbers are already higher than where we are now.
significantly.
Yep.
Yep.
And then we also talk a lot about buybacks.
Yeah. So there are shareholder friendly activities. Number one, not committing fraud is a good one. Number two, paying a dividend is great. Growing your earnings is fantastic. Hiring good people and buying back shares. Companies are buying back their stock at a record pace. And, when you think about a market, prices go up for things when there are more buyers and sellers. How about the fact that it's not just individual investors in the market anymore, or institutions like pension funds, endowments, and sovereign wealth funds? It's also the companies themselves.
Yeah.
They are buying back their own stock. And trust me, they're buying back their stock because they find value in their stock. And for you, a shareholder of these companies, there's scarcity value there. There are less shares outstanding, which means your shares rise. You get more earnings per share. It's a wonderful thing. So when you look at this chart, a little deceiving, but the black dotted line is the trend line, and the far right up top, you can see that actual buybacks have broken the trend, which was good to begin with. And we are charting into a new territory here, moving the trend even higher. That is good for stock prices.
Yes.
Very good.
And the buybacks are not a perfect correlation to the stock market, but there certainly is a trend. And I think investors have not gone unnoticed over the last year that the markets have overall been higher. And you can see that that trend broke above about a year ago.
That's
So,
right.
yep.
Right.
And let's talk a little bit about Apple specifically.
Yeah. So just as an example, Apple's last week they reported earnings. They beat expectations. Expectations were a little weak, but they beat expectations. But on top of that, they increased their dividend and announced a $110 billion stock buyback. $110 billion is larger than 90% of the S&P 500 companies. They're just using that small drop in the bucket to buy back their own stock. Number one. Number two, Bloomberg did a good job of putting some irrelevant quote in there, but to put it in perspective, they say this is as large as the Dominican Republic's entire economy. These are things that are happening only in bull markets, and you're seeing more and more of this stuff.
Yeah, absolutely. And on top of the buybacks, the dividends, right? That's another fuel for the market, and they continue to grow.
Yeah, so companies like Alphabet, which is Google, and Meta, which is Facebook, they also announced for the first time they're going to start paying dividends and buy back shares of their own company. So again,
Growth companies.
growth companies who aren't known for paying dividends, number
Right.
one. Number two of the biggest companies within a week announced that they're going to start paying a dividend. And on top of it, they're buying back more stock. So, again, these things you don't hear in a bear market or a bad market. You only hear about them in a bull market. Well, here we are. You have a lot of bull market activity happening. So, you should feel very good as a long term investor in the stuff that is going on behind the scenes.
Yeah. So I think overall the fundamentals look good. Let's pivot and talk a little bit about some areas to be mindful of if we can. And we've talked about the small business sentiment actually last month's webinar, but it's worth readdressing.
Yeah, it's not all roses, right? So that's why we threw it in here. We didn't want to be too happy.
Yeah.
Uh, Small business sentiment. There are many things that go into sentiment, but we call it sour right now. So
Mhm.
that's a combination of it's expensive to employ people. Regulation is pretty tight when you hear that these small businesses can't be bought out by big businesses when they want to sell to big businesses because the FTC, the Federal Trade Commission, is trying to block all mergers and acquisitions. I think sometimes that they forget, well, that's the plan of small business to either grow into a big business or to be bought out by a big business. So it's the cost of goods, wholesale goods. It is, policy falls into this. Subtly, there are some societal things that fall into this, but ultimately, as measured by small businesses, small business optimism is not good. This is a contrarian chart, so you
Yeah.
do invest when sentiment is sour, because it pivots and can change pretty quickly.
Yeah,
Uh,
if I can just address the sour sentiment that we're seeing is almost, not quite, but almost as bad as the low in the pandemic,
that's a good catch. Yeah, I
right?
wasn't going to
It's
say it.
that sour.
Thank you for pointing it out. So yeah, small business sentiment. And keep in mind, during the pandemic, the world was closed. If you owned a
Right,
small business, you thought it was over.
right.
Uh,
You still have you have a business today, right?
it
Versus the
is
question back then.
it is amazing that sentiment is this low,
Yeah.
uh, but you're seeing it. So
Yeah, and the business owners aren't alone. I think consumers overall are feeling a little sour as well.
absolutely, yeah. It's consumer sentiment is slightly higher than the depths of the pandemic, but not that much higher. You definitely have this below average reading of the consumer. And, there are many things that go into it. The cumulative rate of inflation over the past 3-ish years or so, it's, north of 25%, and growing, yet, slower now, but things are much more expensive. Financing everything is significantly more expensive, exponentially more expensive. You have a lot of societal issues in the sentiment reading, because it's much more emotional than small business. So I think sour consumer sentiment and sour business sentiment, while the backdrop allows or is providing you good fundamentals, is just another reason to be invested, right?
Yes.
Sentiment changes pretty quickly, but something to be mindful. There's some unhappiness amongst consumers and some unhappiness amongst businesses that probably leads to change somewhere, whether
Yeah.
it, the House and Senate, the White House, local elections, policy changes. You're going to see some change. Not who knows where it's going to be, but there's some change coming.
Yeah, it's historically a contrarian indicator that proves to be a positive for the markets ahead.
Yeah.
Yep. And you also have, Bob, an interesting view on what's been going on with the markets in general in terms of indexing.
Yes. So for many of you, you may wake up and turn on CNBC and look at the futures. The futures, which are driven by literally futures trading, and the investors in futures trading are institutions only. You may get depressed, excited. It may alter your emotions when you wake up, turn on CNBC, and you see the futures are up or down, right? And then you see the market move throughout the day, right? No one
Yeah.
really pays attention uh, to the volume that is making the price action move. And then suddenly at the end of the day, sometimes the direction gets stronger and
Mhm.
sometimes the direction changes. Well, because there's so much money in index funds, so much money, probably way too much money, the final half hour of the day really is what matters the most. And the final half hour of the day is driven by index orders, mostly, and institutional orders. Because those orders are so big, they are typically entered as on the close orders. What does that mean? Well, the market closes at 4 o'clock, but the orders are so big that an on the close order gets transacted starting at 3:30 p.m. So for the last half hour of the day, you see a lot of the institutional orders for the day get executed. It almost to me means anything that happened prior to 3:30 really doesn't matter, because the last half hour of the day can either reinforce a good trend or absolutely change a trend, with 30 minutes to go, based on the massive sum of money that is coming in from these index funds. And this is a combination of buying and selling. Index funds selling to create cash for redemptions, or buying because they receive deposits, right?
Yeah.
I don't love this because it means everything prior to 3:30 really matters significantly less. Number one. Number two, I also don't love it because when you buy the entire market, you're buying good companies and horrible companies at the same time.
Correct.
And I believe over the past 20 years, with the rise of indexing, we haven't seen as many bad companies go bankrupt because they're getting capital. They're benefiting from being in an index, whether it's a big index or a small index, they're just getting capital, right?
Hmm. Yeah.
And it's almost like an everyone wins, and then when things go down, everyone loses scenario. Look, we all know that there are great companies, mediocre companies, and horrendous companies. But for the past 20 years, we've seen this trend of everybody wins. It shouldn't be that way because there are some really bad companies out there. I hope this trend does change, and I hope that the bad companies can be flushed out of the system. But the more I see this, the more I know that indexing is getting more of the wallet, and it really shouldn't be. So, what we try to do here is, we don't mind indexing certain parts of a portfolio. We're actually in favor of certain factors, which are indexes. But to buy the bottom of the S&P 500 or the bottom of the Russell 2000, where we know half those companies aren't profitable to begin with, we're not a big fan of that. It
Right.
doesn't make fundamental sense to us.
I was just going to say, these are the types of conversations we have within our investment committee as we make decisions with portfolios as to whether we're going to use an index or an active manager. And if you're an investor of ours, you'll know that we've done both. So,
Yeah,
but
absolutely.
we're constantly aware of this. So thank
Yeah,
you.
good to point this out because there are, when people say, well, the market's fixed. Well, yeah, I guess if you're thinking about index funds, sure.
Yep. Yep. No, thank you. So let's pivot and talk about a more entertaining title, which is You Can Live at the Mall Today.
So there's a shortage of housing, right? There's high interest rates are keeping people in their mortgage. I'm saying it that way because they may not want to be in the house, but they don't want to get out of the mortgage. So you don't have as many listings, right? And you don't have the prime listings because they're just staying in their house. When rates come down to a more normal level, which is probably a full point away from where we are or two, you're going to see much more activity. But for now, you have very few listings. And because of that, you have a shortage of housing, right?
Absolutely.
Well, what we're seeing on this chart is specifically a huge increase in the number of commercial properties being converted or about to be converted to residential in the pipeline has skyrocketed. So if you look at 2024, 25, and 26, you have an enormous amount of plans underway to convert commercial to residential and announced plans to convert commercial properties to residential on the horizon. This is a
Amazing.
massive amount.
Yeah.
And we show you this chart because it looks back to, 2016, just to give you some frame of reference. This is enormous. So there's about to be a lot more housing over the next 2 years than we can imagine, especially if this chart is executed. So things like the empty office building will soon be a full apartment complex, or the half-empty mall will soon have condos attached to the mall. So hence the title, Soon You Can Live at the Mall. And we mean that. You can literally, you will be living at the mall.
Yeah.
Um,
And I think these bars on the right are just giving us an example that we will be talking about this for the foreseeable future. So,
Absolutely.
and how that trend shifts. So thank you.
Yeah, some more to come.
And then change happens fast, which we know in the market, but what are some of the implications of this that it may have on the Fed?
Yeah, intentionally hard to read, but we wanted to put four charts up there that we think are meaningful. This is economic data, but bear with us. The top left, our economy is made up of services and manufacturing. And what you see on the top left chart is recently we had two recessionary readings for manufacturing and for services. I don't think we'll live in that space. However, the indexes that track it, the ISM manufacturing index and the services index, are both slightly in the recessionary arena right now, which I believe was actually unexpected. The Fed is certainly aware of this, which is why, again, I think they are going to be cutting rates soon. That's one. Number two, in the top right, the amount of job openings has been cut in half in a very short amount of time. In a year, you have half the job openings gone. We're now back to a much more tolerable, normal level. There's a little wood to cut there, but we're getting there.
Yeah.
So there are significantly fewer jobs outstanding. Bottom left, this is now the government's live reading, which is actually lower than live inflation reading that we showed earlier. The government's live reading on inflation is 1.9. They don't talk about it, but they did start early this year running a few live data points. So we went right to their website and we used their data. And what you see is they've got a live indicator that shows 1.9% inflation.
We're
Uh,
there.
why don't they talk about it much? Because it is not the actual read. The actual read is higher, which is the lagging data read. I'm sure when Jerome Powell and the Fed starts this rate cutting process, they will put this up on the screen to
Yeah.
say, look, when we measure live, here's why we're doing it. So more to come on that. And the bottom right is a big one. Bottom right is unemployment. So hard to see, you're going to have to squint. But on the bottom right hand side, you have a 3.9% unemployment rate, and the Fed's target is 4. The Fed will cut rates at 4.1, mind you. So if it were just unemployment alone. So we're there. You have all of these, I would call them major categories: unemployment, job openings, live inflation, two parts of the economy, the two parts of the economy, kind of flashing to the Fed that they've accomplished their mission. Now get back to normal.
Right.
We'll
It's
probably
time.
be, yeah, we'll probably be showing you these charts in more detail over the next quarter or two. I have a hunch. For now, we will just breeze over them and talk through them. So there you have it. More to come.
Yep. Thank you. That's great. And one last slide as we finished last month's webinar with a topic around behavioral finance. We thought we would address that one more time with another famous slide from Carl Richards.
Yeah, so how do you make money as an investor? Well, you invest in good things and you wait a long time. Pay no attention to the nanosecond change of opinion and direction of the markets. Pay no attention to what the billionaires are saying because they invest for themselves, not for you. Pay little attention to what goes on day to day and really focus year over year, decade over decade. And when you do that, volatility magically, at least emotionally, gets reduced. Because if you have a year, multi-year, decade time frame to think about your investments, I think we all know the markets go up and down every day, every second, every week, every month. When you stretch it out over time, it's much less volatile, right? It feels like on any given day, anything can happen. But over a long period of time, it doesn't. What typically happens is good things over a long period of time. And if you're invested in the capital markets, it just means you make more money over time. Again, assuming you have a simple philosophy, don't be emotional, have a good allocation, partner with a firm that is, working in your best interest at all times, that has the fiduciary duty, and that can remind you that your time frame should be as an investor should be tied to all the things that you need to live through and want to do in life, and that is spend time with your family, continue to grow your nest egg, retire, live off of your portfolio, leave money to your heirs, charity, leave a legacy, all that stuff. All of that stuff has to be done over time. So as an investor, you really need to focus on time invested and get away from the emotional minute by minute, day by day, talking point by talking point, opinion by opinion. And things just work out quite well when you do that. So
It's easier said than done in the world we live with social media. My 15-year-old now has the Fidelity app and can see her investments on a daily basis. And she has commented. So we
yes.
have to keep focus on the right-hand side of this page and not the left.
Yes. And we know that all of you listening are looking at your accounts on fidelity.com, tracking what happens during the day, at night,
Yeah.
next day, every day. It's fun. Just remember, it's more fun when the markets go up. When they go down, don't look.
And hopefully that's a great way to end, to say we're here. You can always call us if you have any questions, any concerns. But again, our hope today is to give you all a thought that we are comfortable where we are in the market. We do think that even though the Fed has been slow to act, it is coming. There are good things to come. There's some great fundamentals. And as always, we'll keep you abreast of it.
Yep. And of course, if needed, please feel to reach out to any of us at any time. We're here for you. We do these videos for you and no one else. Please keep in touch and don't be shy.
Great. Thanks again, Bob.
Thank you.